Welcome to the Deep Dive. We're here to cut through the noise around market-moving events, and today, well, we're tackling a big one.
Yeah.
The Roblox Q3 2025 earnings call from October 30th.
Yeah, this one was really something.
I mean, you'd be hard-pressed to find better top-line numbers anywhere in tech this quarter. Just phenomenal growth.
Absolutely. But the market reaction, confusion, immediate selling pressure, it was a classic divergence.
Exactly.
Yeah.
So that's our mission today.
Yeah.
Figure out why. They delivered these massive beats everywhere that matters: users, engagement, revenue. It looked like a textbook beat and raise.
It was a beat and raise, but the stock still tanked, 10, 15% right after the call?
Yeah.
So clearly, traders weren't looking at the numbers they just posted. They were focused on profitability, future spending, management's outlook there. That's what we need to unpack.
Okay, let's start right there then with the divergence and the sheer scale of those beats. Bookings, that's the cash users actually spent, came in at $1.92 billion.
Which is just huge, up 70% year over year, smashed consensus.
That kind of velocity at their size, it's incredibly rare.
And, even on GAAP EPS, they technically beat. Now, okay, GAAP EPS for these high-growth companies is often negative, right? They invest so much.
Right.
They reported a loss of $0.37 per share. The street expected 0.49 cents loss. So even on the bottom line, numerically, it was better than expected.
But the real story, I think, is the platform scale. We just have to pause on these user numbers because they are, well, historic. Daily active users, DAUs, 151.5 million.
Up 70% year over year. 70%.
And hours engaged, maybe even more staggering, 39.6 billion hours. That's up 91% year over year, 91.
I mean, if you put up numbers like that 70% user growth, 90% engagement growth at this scale, your stock should be flying.
So that leads right to the market's question. Okay, but at what cost?
Yeah.
Despite all that strength, the net loss was still pretty significant, right? $257.4 million.
Exactly. The market saw the amazing growth, but then it saw the loss and got spooked by the, let's call it the implied investment needed to keep that going.
Right.
And boom, down 10, 15%.
Okay, so let's dig into the quality of that user growth. Because this wasn't just more kids signing up, was it? It speaks to their long-term strategy.
No, not at all. This is maybe the most important strategic point. 2/3 of their total DAUs are now 13 and older.
2/3.
And that older group, they grew 89% year over year. So they're growing way faster than the overall user base.
And engaging more.
Way more. Hours for that 13 plus cohort grew 107% year over year. They now account for 68%, so more than 2/3 of all hours spent on the platform. It shows the genre expansion is working. They're successfully pulling in that older, arguably higher value demographic.
And we saw a huge geographic strength too, right? It wasn't just one region driving this. APAC, Asia Pacific DAUs were up 108%.
And bookings, they're up 110%. So monetization keeping pace with users.
And I have to pause on this one specific number they called out.
Yeah.
Indonesia, bookings growth of 804% year over year.
Yeah, I saw that. 800%. It's not a typo. That kind of regional explosion has to be driving their thinking on monetization.
Absolutely. So how did that translate to actual payers?
That ties right in. Monthly unique payers grew 88% year over year, hit 35.8 million.
Okay, so 88% payer growth versus 70% user growth. That's key.
Exactly. Payer penetration is increasing. They're converting users to spenders at a faster rate. And management pointed to things like rolling out regional pricing earlier in the year. That clearly helped unlock spending in those fast-growing markets, like Southeast Asia.
Makes sense. And the creators, the people actually building the experiences, how are they doing?
They're doing very well, which is vital, right? You need good content. DevEx, the developer exchange payouts, hit a record $427.9 million. That's up 85% year over year. Ecosystem looks very healthy.
Okay, but here's maybe where the first hint of that margin friction comes in. They talk about increasing the DevEx rate.
Right. They recently increased the rate by 8.5%. That's an immediate hit to margins, costs them more per transaction.
So how do they justify that?
Well, they framed it as a strategic move. Basically, talent acquisition. They argued creators look at the whole economic picture, not just the percentage rate, but the rate times the volume of users, plus the tools they get. So they're spending now to lock in the best creators and keep them from going elsewhere.
Investing in the supply side.
Exactly. And they pointed to evidence it's working. Engagement and experiences outside the top 10 actually accelerated, growing 58% in Q3. That suggests, a really deep bench of content, not just a few mega hits carrying the platform.
Okay, so historic growth, fueled by older users,
Yeah.
better monetization, and deliberate investment in creators.
Hmm.
Which brings us right back to the cost, the market's anxiety. Management is pouring money into two big strategic areas, safety and AI.
Yep, those are the big future moats they're trying to build. They explicitly said they want to be the gold standard in safety.
Which you have to be if you want older users and, crucially, big advertising brands eventually.
For sure. And that means serious investment. They mentioned a partnership with the Attorney General's Alliance on Child Safety. And the big one, planning a platform-wide rollout of AI-based facial age estimation.
Facial age estimation. Wow.
Yeah, by early next year. The idea is to properly gate communication, filter interactions based on verified age groups.
That sounds computationally expensive.
Immensely, which is why they talked about increased spending on bare metal data centers, core servers, edge locations, GPUs, just to handle the scale and, importantly, reduce latency.
They mentioned a new edge data center in Brazil specifically for that, right? To cut down lag for South America.
Exactly. These are huge capital projects, not cheap.
And then there's the AI roadmap. That sounded even more ambitious.
It really is. They said they're running over 400 AI systems internally already, but the long-term goal is building these world models.
Okay, tell us about the data they're using for that, because that sounded like the real competitive edge.
Oh, it's their crown jewel, no question. They're training these models on proprietary 3D interaction data. And critically, it's PII compliant, meaning personal info is stripped out or anonymized.
And the scale of that data.
Get this. They estimate they gather over 30,000 years worth of human interaction data every single day.
30,000 years. Daily.
Daily. It gives them this unique, incredibly deep understanding of how people behave and interact in 3D spaces. That's the foundation for enabling AI-powered creation, AI-driven gameplay. They mentioned rolling out that Cube 4D model for multiplayer, letting creators generate complex stuff like vehicles on the fly.
That kind of proprietary, clean data at that velocity.
Yeah,
the competitors can't just replicate that easily. It makes total sense why they're betting so heavily here.
So management was pretty upfront about the trade-off, right?
Absolutely. They basically said, look, our massive scale lets us absorb these costs now. But, and this is the key part, they warned that improvements in cost to serve might be harder to realize for the next few quarters.
Translation. We're choosing to invest heavily now, even if it means margins don't expand in the near term, because we need to build the infrastructure and the moat to handle this 70% growth and secure the future.
And that warning, that near-term margin pressure, that's exactly where the stock stumbled.
Precisely.
Okay, let's look at the forward guidance then, and this conflict between cash flow and expenses. Because it's important to note, despite the net loss, their cash flow was actually really strong.
Very strong. Operating cash flow was $546.2 million, up 121% year over year. Free cash flow, $442.6 million, up 103%. They are generating cash very efficiently.
And they showed a ton of confidence in the immediate term, right? They raised Q4 bookings guidance significantly.
Yeah, raised it to $2 to $2.05 billion. That was well above what the street expected. So the market isn't really worried about Q4 itself. It's looking beyond that.
Right. It sounds like the main hangup was 2026.
Yeah.
What exactly did they signal about margins next year?
They confirmed the fear, basically. They said margins are expected to decline slightly in 2026.
Slightly decline.
Slightly decline. Now, they stress this isn't some runaway cost problem. It's the planned full-year impact of those higher DevEx rates we talked about, plus the continued high investment in infrastructure and safety, like that age estimation system.
So it's deliberate.
Yes, and the core message was actually kind of fascinating. They almost said bookings growth has been too fast, outpacing their ability to deploy the right growth investments effectively. So now they need this period of, quote, slight margin compression to catch up and build out the platform to support the scale they've achieved.
Okay, that makes sense strategically, but why no specific bookings guidance for 2026? They gave that big raise for Q4. Why hold back on the full year?
Good question. They mentioned two main reasons. First, they're coming up against really tough comparisons from this huge 2025 growth. Harder to keep growing at 70%.
Fair enough.
Second, they warned about potential short-term friction from those new safety policies rolling out, particularly the age estimation. That could maybe impact engagement or user growth temporarily as it beds in.
So that lack of a clear number for 2026 just added to the uncertainty.
Exactly. It created a vacuum that the margin fears filled. And it's also worth noting what they're not banking on short-term advertising. They see it as a long-term play, but the focus right now is still genre expansion shooters, racing, sports, trying to capture more of that massive global gaming market they don't have yet.
Right. Okay, now for our mandatory segment. We have to step away from just reporting the facts of the call and look at that market reaction, that friction, with a trade idea. Remember, everyone, this is purely theoretical, educational, absolutely not financial advice.
Got it. So if the market is laser focused on slightly lower margins maybe happening in 2026,
But we just saw it, 70% bookings growth and a massive Q4 guide.
there's a disconnect, right? The thesis here is that the 10-15% drop was an overreaction. It was driven by sensitivity to near-term margin optics, and it kind of ignored the incredibly strong fundamentals, the growth, the cash flow, the raised guidance. This is still a multi-year compounding story.
So what's the actual play? How do you trade that disconnect, theoretically?
Well, the play leans into that huge Q4 guidance. It's a high conviction bet that the sheer scale of the holiday quarter could overwhelm the negative margin narrative, at least temporarily. Meaning, the market might be mispricing the chance of a Q4 beat that's just too big to ignore. So, the outrageous but plausible trade idea: maybe establish a long position, perhaps using something like call options that expires after the Q4 earnings print comes out early next year.
So you're betting on the Q4 numbers themselves being the catalyst.
Exactly. You're betting that Q4 bookings come in so strong, maybe $2.1 billion or even higher, that it forces the market to refocus on the incredible growth momentum and the compounding user base, rather than just worrying about investment spend in 2026. The catalyst isn't a sudden margin improvement, it's sheer undeniable scale in the biggest quarter of the year.
That's definitely a high conviction bet on the power of the Christmas gift card cycle, overriding narrative concerns.
It's a bet on momentum trumping near-term margin optics.
Okay, interesting idea. So to wrap this all up, Roblox is clearly executing a strategy of scale first, build the moat with trust, and AI later. They delivered absolutely historic user growth.
But they explicitly told the market they need to sacrifice some near-term margin expansion to build the safety and tech infrastructure required to sustain that growth, attract older users, and ultimately capture a much bigger piece of the global gaming pie.
And they put a number on that capture, right?
Yeah, they estimate they now have about 3.2% of the global gaming content market. That's up from 2.3% last year. Their stated goal is to get to 10%.
10%. That's ambitious.
Very. And if you connect that ambition back to the massive investment in safety, especially that AI-based age estimation, it raises a final important question for listeners to think about.
Okay, what's that?
How crucial is the successful rollout of that age platform, the thing that governs communication and builds trust, to actually hitting that 10% market share target? I mean, is that system, despite its cost, the key that unlocks the major brands, the high-value older users, and the kind of sustained monetization they need to justify this whole strategy? Is that safety spend really just the price of admission for their future revenue goals?
It's a fascinating thought. The cost of trust is the key to future growth. Okay, that's it for this deep dive. We'll catch you on the next call.